the usual format. I'm going to start off with some brief overview of some macro things going on. Tavi's going to get in more depth on the macro, and then Quentin will get into the mining stocks and the geologic updates. So some exciting things have been going on. This is today we got the University of Michigan surveys, once again, consumer surveys, and we had another 0.9% jump in the mean long-term inflation expectations. This is contrary to what you are hearing from the Fed, that the inflation data is slowing, that inflation is heading towards the 2% target. Inflation expectations, especially long-term inflation expectations, are not well anchored at all, and they are not, even at the median, which is that white line in this chart. They are not coming down towards the 2% target. They're still hanging up around 3%, but the mean of this University of Michigan survey is the biggest concern, because that shows the broad dispersion of inflation expectations, and it's the higher inflation expectations among the lower income classes, the ones that are hurt the most by inflation, and the one where all of their spending, none of their spending is going into savings anyway. It's all going into consumption, and this is a very bad trend for inflation, and it just keeps getting worse. It's not getting better. Let's go on to the next. So we started to see some volatility creep back into the S&P 500. We've had a significant pullback, nothing major, but off of the recent highs. Earlier this month, the S&P 500 was reaching new highs, and we've had a substantial pullback. This is a chart that Nathaniel put together, and what it's showing is the number of days since we've had a 2% or greater single down day in the S&P 500. We just had one this week, and we hadn't had one since 2007. So this is when you look at this chart, you can see how normally over time, look at how the blue lines are much lower between the 0 and 100 days. Normally, we have much more frequent down days in the S&P 500 of 2% or more. It used to be a normal thing, back in the days, and maybe it's going to start to become a normal thing again. Certainly, volatility is increasing, but we're still coming off of very low levels for VIX. And of course, we're anticipating a recession. We're anticipating a correction, a bigger correction to come in the S&P 500 off of historic valuations, especially for the Magnificent Seven. We're seeing what we've been calling the Great Rotation coming. You're hearing Bloomberg talk about the Great Rotation, and other managers now coming on and talking about the Great Rotation. We agree on what people will be rotating out of, and that's the mega cap tech stocks, most certainly, the other large cap growth stocks, and overvalued large cap growth stocks in general. But it's broader than just large cap growth. The S&P 500 at large still has historic valuations in aggregate, and there's a number of other industry groups that are at risk, including consumer discretionary. But our great rotation thesis really relies on rotating out of overvalued financial assets, which includes fixed income securities. And we've been talking about this for a couple of years, and we've gotten this right. As the long end of the curve, rates have risen substantially on the long end of the curve, but it's rotating into undervalued commodities and natural resource stocks amidst supply constraints. We are starting to see glimpses of this, but the bigger rotation into commodities is only just beginning. and the opportunity, the deep value, high growth opportunity in the commodity stocks. This is what the real great rotation is all about. Is a rotation into commodities, and we have hardly even begun to see it yet, but we're starting to. And into commodity resource equities, where we are positioned substantially on the long side. Let's go on to my last chart. So this is looking at Google's earnings. We've been talking about the creative destruction that's likely in the mega cap tech stocks because of AI. This AI euphoria has led to an even further increase in the prices of the Magnificent Seven stocks and in the concentration of those stocks in the S&P 500. But what is really going on with this AI revolution, this AI euphoria? It's a theme of creative destruction, where the new technology is jeopardizing these monopoly business models of these mega cap tech stocks. And so how's that happening with Google, and why hasn't this narrative even been discussed with Google? I don't know why the narrative is not being discussed, because a lot of the analysts will still come on and say Google had a great quarter, but they're not looking at free cash flow. They're not looking at the CapEx trends. Guess what? Google's free cash flow last quarter was down 40% year over year. Their CapEx increased year over year from $7 billion to $13 billion. They're having to spend like $100 billion a year, including R&D and CapEx now, to get into the AI game in a bigger way. They're trying to compete with Amazon on cloud services, with Amazon and Microsoft. It's not their traditional business model. Their profits come from search and advertising. At the same time, their search model is being threatened. Their advertising and search model is being threatened because of AI and the new search technologies that these large language models allow, that allow other competitors to be coming into the game and allow places for people to do their searching outside of Google. How's Google going to collect ad revenues if people are not searching on Google? And they're starting to move their searches to other platforms like Perplexity or even Bing. So this is creative destruction. This is competition that threatens these monopoly business models. Google's operating cash flow was down. That's not growth. It was down year over year. Their free cash flow was down 40%. How are these companies going to capitalize on this increased huge investment? This is the same problem that we had at the peak of the tech bubble, when the CapEx was just screaming up off the charts as everyone was trying to invest in fiber optic cables and Cisco routers, and there was, but that was the peak of the business cycle. It was not sustainable.